So 3 years ago, an AI app might have had 0% gross margins. Today, that same app using the same quality model has 80% gross margins. That's a massive improvement, and it's driven by a falling cost curve and better optimizations.
That's like a step change function. That's a completely different company.
From my observation, the best CFOs have the founder's mindset without the founder title. So they're relentless in the pursuit of truth. And importantly, that energy impacts not just the finance function, but everyone across the company.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast, where we talk to CFOs, business model experts, and the investors that fund them. And today we got one of the best investors in the game, Alex Immerman, partner at Andreessen Horowitz. He's worked with some of the best CFOs across their portfolio. We'll kick off talking about what sets high-performing CFOs apart, how they show up in investor meetings, build trust with the board, and shape the tone at the top. And if you've ever wondered what VCs really look for when interviewing CFOs, I've interviewed with a couple of investors during my stint. Alex shares his favorite question to test their edge and what separates the spreadsheet whisperers from strategic operators. What a terrible term. Then we shift into the age of AI. What should CFOs actually own when a company goes all in on AI? How does that reshape org charts, margins, and financial frameworks? And are we finally seeing a new definition of efficiency take hold? Is it ARR per head? What's happening there? Plus, we'll demystify investor logic, like why LTV to CAC still gets top billing, what a compound metric, how to adjust payback periods for margin realities, you got to gross margin adjust it, and what it really means to be public company ready today. If you're a CFO thinking about their next level, or an operator wondering what investors actually want, this one is for you. All this and much, much more after a short word from our sponsors. This episode of Run the Numbers is brought to you by Navan, the all-in-one travel and expense solution. CFOs and finance leaders, let's be honest here. Your T&E process is broken. Manual reconciliations waste valuable time, policy violations drain money, and limited visibility creates unnecessary risk. Nobody likes that. Navan cuts through these problems, giving finance teams the clarity and control needed to close with confidence, faster and with fewer headaches. Connect your existing eligible Visa, MasterCard, or American Express cards directly to Navan and keep all your card rewards and banking relationships. Get real-time expense tracking, automated policy enforcement, and AI-powered reconciliation that works. Companies like Anthropic, Unilever, and Zoom trust Navan to manage travel spend smarter and increase compliance. Are you ready to modernize your T&E process? Visit navan.com/runthenumbers for your demo today. That's navan.com/runthenumbers. Tell them CJ sent you, they'll hook you up. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell me your boy CJ saying planful.com/metrics. Alex, welcome to the Run the Numbers podcast.
Thanks, CJ. Excited to be here.
For the 150 times I've said welcome to the Run the Numbers podcast, I think I just forgot the name of my own podcast to kick stuff. We're off to a hot start. I'm 4 coffees in. I'm ready to go.
I've listened to a few episodes. I've enjoyed listening to it. And in a different life, I'd have tried to be a CFO myself.
Well, that's good because I'm going to ask you your opinion on CFOs from the other side of the table, being a successful investor at a16z's. And I know you've worked with a lot of great CFOs throughout your investing career. It's kind of a hard question, but if you had to distill it down to one or two characteristics, what do you think separates the good CFOs from the great ones?
I have been fortunate to partner with many great CFOs from small to large companies. And when I reflect on these experiences, I'm probably not going to limit to one or two qualities. Maybe I'll give you three.
Okay.
A strategic mind, tenacious energy, and a long-term orientation. So on a strategic mind, top CFOs, they're not just bean counters, they're a thought partner to the CEO. They're willing to challenge the CEO with an alternative viewpoint. Second, on energy, from my observation, the best CFOs have the founder's mindset without the founder title. So they're relentless in the pursuit of truth. And importantly, that energy impacts not just the finance function, but everyone across the company, everyone from product and sales. They know they need to maintain a high bar for performance. Results really matter. And then the third piece, that long-term orientation. Yes, they care that the company is not going to run out of cash today, but I love when a CFO has the courage to back unproven bets that could take a year or longer to pay off. They realize that investing in that new product area may not deliver meaningful revenue in the short term, but it's the right decision for 5-10 years out. So strategic mind, tenacious energy, long-term orientation. I gave you 3, not 2.
3 is good. 3 is good. When you started with the strategic mind part, my mind instantly went to like all the LinkedIn emails where it's like, we're looking for a strategic CFO. And we joked with my buddy Steve Isom of Bloomerang, who's a CFO in a JMI portfolio company. We were saying like the buzzword, I think, of 2024 was to find a strategic CFO. But I wish they could hear what you said about it, because I find that like the strategic side of being a CFO is not being afraid of friction and being able to push back. And I love that you said you're willing, like you can own your voice. You're able to give a CEO alternative paths that you may take. So I just want to say that version of strategic actually resonated with me. I like it.
Yeah, you probably have to combine it with the energy piece, right? You need to be able to willing to push that across the organization and make sure it permeates everywhere.
In founder's mindset, that's such a great way of putting it. And I wish I had encapsulated it that way when I talk about even like in interviews, I've tried to say I have a lot of energy, but I'm like, how do I detail that in like a way that's more actionable? And I think a founder's mindset is great because it's showing that you're always pushing the limit and you're thinking more innovative about things. You're not like, oh, I'm in the back office here. It's like, I'm actually thinking about how we sell this thing off the back of the truck when we have software to sell.
You know, we've been fortunate to be long investors in Stripe, and John Collison, who is actually the co-founder and president at Stripe, back in 2023, he took over the finance department. And so he brought incredible intensity around efficiency. And the results that year just like spoke for themselves. We ran this analysis where if you compared Stripe to all public companies with $1 billion of revenue, they were in the top 1% of single year margin expansion gains. So basically, no one at scale ever gained as many points of margin in a year. And, you know, there's an argument that maybe that can only happen when you have a founder or someone near founder intensity at the helm. And that's a company that, of course, is balancing with the long term and innovating constantly. Last year, pushing into stable coins when none of their peers are even thinking about it.
I love that. And then the last component there, backing unproven bets. Like at the core of any CFO's job, I think it's resource allocation. And no one's ever going to fire you for saying no to something that's unproven. Like it's a much harder thing to do to say, okay, I know I'm getting a bit ahead of my skis here, but it kind of links to the founder's mindset thing. Like you have to push the limit to keep innovating.
Totally. And I think Jason at Robinhood has done a great job on this. Everyone thinks about them for their core trading offering in the United States. But last year they had their first investor day, and he, came out talking about international expansion and neobanking, their card products. But it was all grounded, to your point, in a section around shareholder value creation, right? So it's not just like, hey, we're going to go do these, crazy experiments, but we are going to be rooted in driving like value per share.
I think the CFOs that people picture, just like in movies, or the stereotype is the one who's saying no to a lot of things. And they're like, hey, I'm the only one playing goalie here, right? But I think the CFOs who are going to stand out in the next 10 years or so are the ones who have their foot on the gas. Like they can still make sure that, nothing's getting by the goalie, but at the same time, backing unproven bets. That was a great encapsulation.
Yeah, and like on related to that point, Jason was there during the GameStop craziness days, and he was super responsible, making sure they got the capital they needed quickly. So he's not just the long-term thinker, but he's making sure that the business is fiscally responsible.
Alex, in your role, do you ever get pulled in to interview CFOs for portfolio companies?
I do.
Do you have a favorite question to test their mettle?
Yeah, I mean, I have some staples like today your business is 30 to 50 million dollars of revenue. How different is it going to look at a few hundred million of revenue? If you had to cut burn really fast, how would you do it? My personal favorite is tell me about a time you disagreed strongly with a CEO and what happened. So a great CFO is not just a numbers person, but a strategic counterweight. We were talking about the strategic mind earlier. And this question is important for assessing that. One, do you have a backbone? Do you have the chutzpah to stand up in a difficult situation? By the way, if your example is not a difficult situation, you probably don't have a backbone. Do you have the communication skills to thoughtfully disagree? Do you have the respect and trust of the CEO? What I'm trying to glean is whether the candidate is a pushover and the CEO hopefully does not want to bring on a pushover.
What types of scenarios do you usually get as a response? Because like there are questions always around like fiduciary responsibility, like you can't do anything shady, but I guess there's a gray area too where it's like, is this a good resource allocation decision?
Yeah, I would think about it as a meaty strategic question. So one from last week was around international expansion, and is now the right time. The CEO was thinking, yes, let's go, let's put a rep out in Europe. And the CFO pushed back. He was saying, you actually need a sales engineer, you need onboarding, support, localization. And the best first step could be hiring a rep domestically in the United States that spends a lot of their time thinking about Europe and proves out the demand there. Because if you're going to build a whole pod in Europe, that's a much more meaningful expense. You have to pull forward, raising capital, all those types of things. And so, that's a type of question that a CFO definitely should opine on, might make a board level conversation and makes for a good example here.
Yeah. I think in a lot of ways, the best CFOs are liked even when they make non-likable decisions. And what I'm trying to say, I think, is like you're often put in these positions that are inherently disagreeable. But if you have the trust of your peers to make that call and they're like, I didn't like the outcome of that decision or exactly like where your mind was at, like with going international, but like I respect where you're coming from and I appreciate you pushing back. Like that means a lot.
Yeah, and I'm sure we'll chat a little bit about like what makes a good CFO investor or board relationship, but a lot of it is around building trust right at the onset and getting those reps. And I think that applies just as well to the CEO as well.
Well, before we get there, on the flip side, how do you think CFOs should engage with investors during the hiring process?
I'm always intrigued by the questions that candidates ask me. Probably the most common example is, why did you invest? Walk me through your thesis. What's changed since you made your investment? And the best conversations are discussions versus question and answer sessions. So the candidate might ask me about my thesis, but they should also push back or ask questions and share what's exciting them, what their differentiated view might be. This question also shows you're being thoughtful about how investors look at the business, what the story is, what's compelling to outsiders. So I always love engaging in this because it also shows me that the candidate is deep in the business and thinking about the right issues.
What do you think if a candidate pushes back and actually points out like a potential blind spot in the business?
I think that's rare that they really have unearthed something that I'm unfamiliar with.
Yeah.
I mean, at least I hope so. I think they're often pointing to the right risks. They're pointing to the things that kept us up at night, and we're sharing the mitigants, the things we thought through that made us comfortable with the investment and what's changed. Because a lot of times when we invest, we see a risk, we have a concerning area, and we share that back. We present that back to the entrepreneur. And if they agree that it's an issue, they'll work on, mitigating that issue going forward. So a lot of times I'm talking to a candidate and I can like talk through what's changed since the investment to make that less concerning.
Hey, thanks for listening. We'll be right back after a word from our sponsors. If you're a CFO trying to keep up with usage-based billing, complex contracts, and a finance team drowning in spreadsheets, listen up. Meet Tabs. Tabs is the AI-native platform automating contract to revenue for finance teams that are scaling fast. Whether you're selling custom terms, usage-based pricing, or a mix of PLG and sales-led, been there, Tabs turns month-end chaos into clean cash flow. It's like having a controller that never sleeps and a billing analyst who actually understands your pricing model. No more manual reconciliations, no more late-night close deadlines, just clean data from contract to cash. It used to drive me nuts that we do all the work to close the books inside our ERP in our FP&A tool, and then we had to export the most important part, revenue, to this janky spreadsheet and manually calculate what we did that period. And don't even get me started on the back of the envelope calcs we did to get to ARR based on all the unique contract terms we had floating around. Our investors would wince if they knew. Let's be honest, legacy systems here are not going to cut it, folks. Tabs is the system I wish I had in my CFO days. Fast-growing companies like Cortex, StatSig, Cursor, and others are already using Tabs to instantly generate invoices from any contract, automate RevRec, cash application, and get finance out of manual mode. If you want to automate the mess and fix the way money enters the building, baby, go check out tabs.inc/metrics. Again, that is tabs.inc/metrics. And if your team's still closing the books like it's 2015, now's a good time to upgrade. Hey, metrics fans, let me ask you something. Do you know what keeps CFOs and finance teams up at night? Well, it's not the complex analyses or forecasting models. It's the mind-numbing tasks of chasing receipts, reconciling expenses, and juggling 5 different systems just to track company spending. I was talking with a finance leader last week who calculated her team was spending an astonishing 20 hours weekly just on expense administration. That's nearly 1,000 hours annually on low-value tasks. That's why I'm excited to tell you about Rippling Spend. Rippling Spend is the only platform that automatically handles your entire company's spending in one unified system. What makes it different? It's built on Rippling's workforce platform. So when org changes happen, like someone getting promoted or changing departments, all approval workflows, access permissions, and policies update automatically. Picture this. When your marketing director goes on vacation, expense approvals don't sit in their inbox waiting for their return. Instead, they're automatically routed to the right backup approver. No manual delegation needed. Meanwhile, your finance team gets real-time visibility into all company spending with no more month-end surprises. As a Run the Numbers listener, you can get an exclusive demo showing exactly how much time your org would save. Just visit rippling.com/metrics to learn more. That's rippling.com/metrics. Do it, guys. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. Yeah, and I think what I'm poking at is you probably do want to see that they're using some level of critical thinking to show that, hey, I'm serious about having skin in the game here. I'm making an investment decision. I can only invest in one place at a time.
Totally. They only have one job, one company, and so they better be doing their work. And that again is why I like the question. Like they want to know what we saw. We spent a bunch of time speaking to 15, 20 customers. It's hard to do that as a candidate, right? So yes, they are doing tons of work to assess the company, but there's some limitations in what they can do versus, what I'm able to do with my team.
Totally. Yeah. Let me tell you, I've tried it. It's hard to do channel checks from this side of the table.
I mean, for sure.
Once in a seat, though, what does a great CFO-investor relationship look like? So they land the job, they're working with you quarter to quarter.
What I just referred to, it's all about trust and candor at the foundation. So there's this baseline expectation that the standard financial statements will be correct, but coming in and sharing those metrics that don't have GAAP accounting standards, how you're going to define them, what assumptions go into them, just being super upfront. And similarly, if there's going to be bad news, share it quickly. You don't want the board member doing calculus in the board meeting and unearthing a surprise. And then one other area I would highlight is there are some elements of the job that feel like reporting, but you're not a reporter. A CFO is not a reporter. They're a thought partner. And I want to hear your perspective on topics that are not down the fairway finance. So we're talking about go-to-market in the board meeting. Share what's happening on Deal Desk. Or the product team is talking about potentially building in a new area. We have all this cash. Should we be building in that area? Should we be, buying some software product? And then, we're launching this new AI product. How should we price it? How should we think about that? It comes back to being a strategic counterweight, a strategic mind.
Alex, can you elaborate more on the need to share bad news quickly?
Yeah, I mean, look, I think some might say, hey, let us figure things out. And
yeah,
just give us a little time to figure it out. And I think that that is a reasonable, natural tendency. And in a lot of cases, the board member can only help to some degree. But in many instances, we have seen a similar situation at another company or know someone who can help, can make an introduction. And telling us sooner allows us to have an impact sooner and correct the situation sooner. And so waiting is often, not the right call.
I want to talk about power dynamics and communication because the CFO is often the closest to investors other than the CEO. And
Yes.
I guess you could say like they have a direct reporting line of sorts to the board, but like the CEO is still their job. What are your observations on that dynamic in practice?
Yeah, you are correct. The CEO is the board's primary partner. The CFO technically reports to the CEO, but is often the board's most trusted operator. They most closely speak investor language around financials, return on investment, capital allocation. One distinction I often see is the CEO sells the dream and the CFO validates it. So one great example of this was from our investment in Roblox. Dave Baszucki is an incredible visionary. He can articulate this sweeping vision of the metaverse and explain how Roblox is not just a platform for young kids, but evolving to serve older children and even adults. And then, back in 2019, 2020, the CFO, Mike Guthrie, would come in and he'd show us the data. Older user cohorts growing faster than younger user cohorts. Content quality was improving. Mature age content was growing share. And it made Dave's vision feel not just bold, but believable. And over the last 5 years, Roblox has done an outstanding job aging up.
Wow, that's a great example. Thanks for sharing that with us. Alex, are there certain issues you'd want to hear from the CEO directly versus the CFO? Like, is there something that the CFO should be the one to pick up the phone and call you on?
So every CEO and CFO relationship is different. There's not one size fits all.
Yeah.
Most common is the CEO is this chief storyteller, culture carrier. They come in around strategy, vision, big bets, org design. The CFO is typically responsible for financial performance, capital, runway, key performance metrics. So that's where I most commonly hear from the CFO. But importantly, they're going to be partners on a lot of topics, and I want to hear from them both. I want them to have a peer-to-peer relationship in a lot of discussions. So if you were to take fundraising, for example, the CEO may own the pitch and the CFO might own the model, but they should be engaged deeply on both and sharing their perspectives on both.
Yeah, that totally checks out. And I think to a certain extent, if there's an issue that like just the CFO should be calling you, then something's probably broken in the relationship between the CEO and CFO.
Yeah. And I think at least 9 out of 10 times, the CEO should know first about what the issue is before the CFO is calling me. But the CEO, to this whole point of building trust, the CEO trusts the CFO to give the investor the call, explain the situation, and work through it together.
Yeah, I'm thinking of like this meme of the CEO, like, I'm not really much of a numbers guy, I'm the visionary. So leave that to CJ. All right, Alex, I want to talk about how things are changing now. You're at the forefront of investing in a lot of cool companies that are using AI. How do you think the role of the CFO is changing now that there are all these tools out there?
Yeah, I mean, the role of the CFO function is changing rapidly. There are certainly some functions like, developers that are evolving faster. Like Cursor has been a complete game changer for software engineers. And we're a little earlier on that trajectory for CFOs, but you can now ask your AI copilot, how much are you spending on a certain vendor? Or when does the contract expire? Or please run me this extra sensitivity. CFOs are expected to be more real-time oriented in this age of AI. And with more information at your fingertips, that enables CFOs to be even more strategic than in the past. With AI, a few important strategic questions have come to the forefront. So one, should we be growing faster now that we have a new AI module? what should our expectations be for retention on that product, gross margins, how should we price our AI solution? And so every role is changing with the prevalence of AI, and the CFO is no different.
It's interesting that CFOs, at least it seems, I'm doing a survey on it right now to figure out the truth. Everyone feels like they're behind. And so I'm like, are we actually? So TBD on that. I do wonder though, like you think we use
So the models have gotten a lot better with numbers, over the last few months. And prior to that, it was much more around language. So I do think the CFOs were seeing their colleagues use AI a lot faster, a lot more swiftly. There was the hallucination considerations, but things have gotten a lot better. And so I do think the tools for CFOs are coming and coming fast.
Yeah, it's like, why can't I vibe code this massive sum if?
I'm pretty sure that all of them are starting to build in AI functions into, Excel, Google Sheets, where you can effectively prompt what you want to happen in the cell.
People like kind of crap on Excel all the time, like, oh, why are you still in Excel? But like, I just want to say, Excel's like probably the best software tool ever created, actually.
I definitely agree, and we're investors in Hebbia, and George, like he and I bonded our first meeting over our love and admiration for Excel, because it's one of these products that it started perhaps in the finance function, but today has permeated like grade schools. It's a completely horizontal tool, and just everyone is reliant on it. And when you meet like vertical software companies, number one and two like top competitors are pen and paper and Excel. It's not
Yeah.
like another vertical software company.
I love that you pointed that out, that it's often the best alternative to anything else out there, and people are still trying to replace it. It is interesting though when you think about like, will an AI native company in finance be the category leader, or will it go to an incumbent? Because I remember when GitHub Copilot came out, it's like, oh well, they have a ton of users, like that makes a ton of sense. Like their distribution is kind of, it's hooked up from the get go. Excel, like I guess Microsoft has that example of being able to just use the billions of people that use Excel every day. But then you have other companies that are AI native in the finance space. So I don't really know where the puck is going, but I do find it a fascinating trend of incumbents versus AI native finance companies.
Yeah, I mean, we're always thinking about can the incumbent innovate faster than the startup can get distribution? And to the example you just gave around GitHub Copilot, we've just seen the like mass proliferation of Cursor, and it's been reported, but it's quickly catching up on a revenue scale, and we're talking about a product that's barely more than a year old in commercialization. It is
Wow.
unbelievable how fast these companies can get distribution. Certainly, like engineering is a more an early adopter market than CFOs and maybe the Excel replacement tool. But I do think there's going to be a massive opportunity in financial services to bring these tools to bear for CFOs.
Yeah, I think some of the CFOs got spooked though with some of the hallucinations at first. Like you'd plug something in, and whenever you intuitively know it's wrong, it's like, okay, now I feel like I've been snake bitten here a bit.
I get it, but I also think you have to be using these tools. You need to be on the right side of history. And if you're playing around with these tools over the last 12 months, you've come to appreciate how much better and better they're getting. Memory is now becoming a part of ChatGPT and Grok and other tools. And so you, if you commit to playing around with these tools over time, you're going to see the benefits.
Yeah, yeah. And a lot of companies are trying to figure out who picks up what when it comes to advancing an AI agenda. What components do you think the CFO should own?
A CFO can be most responsible for pushing how AI is deployed within your company, while a CTO or a chief product officer drives more how AI gets built into your product offering. Toby Lutke is not a CFO. He's the founder and CEO of Shopify. You may have seen his company email that leaked, but it was amazing on this topic. one of my favorite parts of the memo, before asking for more headcount or resources, teams must demonstrate why they cannot get what they want done using AI. So if you're a CFO and your customer support team wants more headcount to respond to customers, you should absolutely be asking them, have you tried Decagon? Or if your head of engineering wants more headcount, the team better already be leveraging Cursor. It comes to this tenacious energy I was talking about earlier. The CFO's job is to ensure financial responsibility, and AI can be a tool for driving efficiency within the company.
There was this IT guy I used to work with, and inevitably, like being an in-office IT guy stinks because everyone just bugs you about stuff like as soon as it happens. And it got to a point where he put up this huge sign in front of his desk. So he'd be turning around, you'd walk over, and it says, "Did you file a Jira ticket yet?" And I feel like the office of the CFO should have that. Like when their headcount requests come up, it's like, "Did you try to solve any of this with AI yet?"
Yeah, speaking of tickets, one of my favorite examples with Decagon is within 1 month of deployment at Duolingo, they were able to handle and fully resolve 80% of inquiries. So that
What?
dramatically reduced ticket volume. And now the human agents just have to focus on the complex inquiries.
So I'm 90% sure. So I write on Substack, and every once in a while I have a question. I think your investors
We
in
are, we
Substack
are.
too, but I think they use Decagon for the customer support
Mm-hmm.
stuff, and it's like the best customer support ticketing thing ever. Like it blows like my Bank of America like chatbot out of the water.
Well, I don't know that Bank of America should be the baseline, but it is amazing, and it's being trusted by, I mean, we just named like consumer examples in Duolingo and Substack,
Yeah.
but it's being used by financial services companies. Like it's being used by Built and Wealthsimple and Chime. So it's not just about like consumer companies where hallucinations may be acceptable. It's being used in really high trust, high accuracy scenarios.
Yeah. Yeah. And that's where the rubber hits the road, right? Like when there's money involved.
Totally.
Like when I reflect on how AI is being used internally, because there's a lot of noise, a lot of stuff being written about how you increase revenue with AI. But then it's like, if I'm a CFO, how do I get more leverage internally out of it? The two ways, and you can correct me where I go off the rails here, but I think like there are customer support examples or like very rote examples of like things that happen every single day. Like maybe it's like accounts payable if you can get it right. If you laid down enough tracks, you can have an AI agent travel upon it. That reduces headcount. But the other way is like more efficiencies around like how do you go faster? And I don't think like you're going to get like a 100x engineer or a 100x like financial analyst like this year or anything, but a 30 or 40% like improvement in efficiency, that's a game changer over time.
Absolutely. I mean, you're right. Customer support is a very common use case. Uh, Engineering has been phenomenal. Marketing, we're seeing some momentum in sales as well. So I think there's like tons and tons of use cases that are happening. I think the call it calibration or the distinction between copilot and autopilot are probably going to happen more in the industries we just named. Whereas like finance tools, probably more on the copilot side because there's this element of building trust, accuracy. The CFO must be right, all those types of things.
Yeah, I was talking to a founder and they were saying like our AP tool is 98% correct. I'm like, what about the other 2% though? Like, dude.
Absolutely.
Alex, I got an investor. I got an investor on the podcast, so I got to take advantage of this. I need to code some logic here. So something like as an operator I've often struggled with is the weight that investors place on LTV to CAC. It's like such a compound metric. There's a lot going on in there. Can you explain why that metric is so important to investors?
Yeah, I get why people inside companies sometimes roll their eyes at LTV to CAC. There's many different components. You increase your price, then churn may increase, your CAC may increase. It's an output metric, but investors care, and all shareholders, including employees, should care, because higher LTV to CAC translates to higher margins, which is correlated with higher valuations. So it turns out that R&D and G&A margins tend to be relatively constant across mature companies. And so if you think about what drives profit margins, sales and marketing efficiency is the most important quality. So higher LTV to CAC as a proxy for sales and marketing efficiency means higher margins, and higher margins, more cash flow, higher value. We ran the numbers, and a 3x LTV to CAC business has a 3 times higher valuation multiple than a 2x LTV to CAC. So just one turn in LTV to CAC is a 3x higher valuation multiple. Huge difference. And even though it's an output metric, it's one that's worth monitoring.
I really love that explanation. And that's wild, like that much value creation just from one extra turn. I think where operators struggle with it is like if they don't like the output, it's not as simple as being like, well, Bob over there owns LTV to CAC. Like there isn't one person in the org.
I mean, it is definitely an output metric, and there's, all the different components that go into it. One other way to think about it is if you invest $100 of CAC so upfront, and you're generating a 2x versus a 3x, that means you get $200 versus $300 of gross profit back. That's an extra $100 that you can reinvest into R&D, deliver a better product, invest in other areas. And so it's a growth mechanism for your business if you're able to drive higher LTV to CAC.
Alex, does the LTV to CAC ratio differ by sector? So for example, I know you've invested in a lot of great fintech companies. Is it different versus like B2B SaaS?
So when I think about sales efficiency by segment, I'm typically thinking about it less by sector and more by like SMB versus enterprise. And part of that is because all of these metrics are gross margin adjusting. And so, financial services products may have lower gross margins, but I'm factoring that into the metric we're calculating versus a B2B SaaS tool that has 70 or 80% gross margins. SMB businesses, because they tend to have lower retention, I care about paybacks being faster because they're less likely to retain and drive returns in the outer years. Whereas if you're an enterprise product, it can be okay if your paybacks take 2 years because you're going to have 95% gross retention. You're going to have 120% net retention. And the LTV to CAC is going to look really good over a 5+ year trajectory. But if you're serving an SMB and the company isn't going to be using your product in 2 years' time, you have to juice the returns really fast.
I think it gets to the point of why it's so important to gross margin adjust your CAC payback period too, right?
Totally. I mean, if you're not gross margin adjusting your payback period, you're fooling yourself on how quickly you're paying back a customer. So imagine you're an e-commerce company and your customer acquisition spend is $100 and you sell products worth $100 over the first year. Your payback periods appear to be 1 year on a revenue basis. But if your gross margins are 50%, all of a sudden your paybacks are 2 years, ignoring retention dynamics. I think right now, in this like new wave of AI native companies and unit economics, I'm spending way more time thinking about retention. Maybe if you want me to chat a little bit about that.
Yeah, totally.
So AI companies are growing way faster than historical precedents. You may have seen Stripe published its AI customers are growing 3x faster than its SaaS customers were in 2018. You've probably seen the meme on X and LinkedIn. Companies are hitting 100 million in revenue faster than ever before. Headline, like AI products, they're truly magical. But many do have a novelty factor. Users are experimenting and playing around. That's great for growth, but not always so great for retention. And so the question I have been spending more and more time thinking about is the retention curves. There's often a spike in their churn in the first few months. That's fine, even expected. But I want to see whether that curve flattens over time. And that flattening tells you the remaining customers are building habits around the product.
And what's lost in the narrative around, oh, this company hit 100 million in 9 months, is if it's an annual contract, there hasn't been a renewal period yet.
Absolutely. I think for a lot of these companies, they're not necessarily annual like annual subscription products. A lot of
Yeah.
them are like month to month, but that dynamic is definitely true. And I think as an investor, investing in AI native companies, I think that's why doing like customer calls is even more important today, because these companies are going from like 0 to double digits in revenue or 10 to 50 million in revenue. And you meet them, and the vast majority of customers have not been through a renewal cycle, right? And so you need
Yeah.
to ensure that the customers are really satisfied and getting value out of the product.
If you're thinking about investing in an AI native company and their gross margin is lower, at least for the time being, like, do you have to think about this in a different box than typical B2B SaaS? It's not AI native.
Yeah, I mean, this is a hot topic these days. The short term answer is gross margins always matter. If your gross margins suck long term, it's structurally hard to have high cash flow margins. So, to your example, think about a classic SaaS business. It's running at 70% gross margins. There's a tried and true story. It's been underwritten countless times of getting to high free cash flow margins. In contrast, many AI native software companies are showing up with 0 to 50% gross margins, way, way lower than SaaS predecessors. And an unsophisticated reaction would be, oh my God, what a horror. But there's nuance. If your gross margins are low because of model inference costs, that's okay. So 3 years ago, an AI app might have had 0% gross margins. Today, that same app using the same quality model has 80% gross margins. That's a massive
Wow.
improvement, and it's driven by a falling cost curve and better optimizations.
That's like a step change function. That's a completely different company.
It is. And look, one framework for how to think about this is, one, are your margins low because of LLM costs? Yes. Okay. I'm interested because LLM costs are going to continue to decline. And in the future, most apps won't require the most expensive, highest quality frontier model. And then two, like, if yes, LLM costs are the driver of my margins being low. Have you built something that adds value beyond the model? Because if you have proprietary workflows, integrations, differentiated distribution, you're going to be in a position to command premium pricing on top of falling infrastructure costs. So that's how you get that recipe for margin expansion. And I can overlook short-term gross margins being underwhelming and think long-term with higher gross margins.
Wow, that's a powerful recipe right there. I think the canonical example, and it wasn't in the age of AI yet, but Snowflake, I think when they IPO'd, they were around 60% gross margin, may have even been lower. And now they've crept it up to B2B software looking gross margins.
Yeah, that's a great infrastructure example. I mean, most of the examples in which I'm seeing it today, and I'm like willing to give the benefit of the doubt, happen to be more on the application side, because
Yeah.
they're relying on a third party infrastructure provider where the costs are falling. Even Sam Altman, right? He had this post on X where he said OpenAI Pro subscriptions were losing money, and people were just using the product more than he expected. So on the surface, that's really bad for near term burn. But Sam knows his LLM costs are going to keep falling. And when they do, the OpenAI Pro subscriptions can be profitable even with heavy consumer usage.
Yeah, people were trying to make those Ghibli memes or whatever it's called. I'm probably butchering the name, but like cartoons are driving them to high burn.
Exactly.
I want to switch gears a bit and talk about public company readiness. It seems like we may have some IPOs this year, right? I don't know. But what is
I hope so. I hope so.
me and
Tariffs
you both?
permitting. Tariffs
Yeah.
permitting.
Yeah. Investors need returns. CJ needs S1s to write about. So IPO gods, if you're out there.
Well, you still got the S1s even without the actual IPOs to talk
I
about, right?
know. I still got to write about StubHub and Klarna, even though they shelved theirs for the time being. I think Klarna, though, shelved their IPO for the time being because they saw that I was beating them up on their adjusted EBITDA margins. But maybe it was the tariffs.
Yet yesterday, someone reported that 60% of Coachella tickets were purchased with BNPL providers. So Klarna's doing okay.
Wow. You can break your burrito delivery from Chipotle into 4 payments now, too.
Exactly. I mean, I think the real story there is that the younger generation is starting to trade credit cards for BNPL.
Yeah, that's a cool story. Alex, what does it take to be a public company ready CFO today, especially if you're in this market?
When I think about public company readiness, there are a few questions I'm asking around growth, operating leverage, and predictability. So, first, can you tell a compelling story for long term compounding growth? Investors want to believe you can sustain 20% plus growth for 5 to 10 years. And that can mean articulating why your TAM is still early, how you're unlocking new acts via product expansion, international growth, why your competitive position will remain strong. So take Airbnb, for example. Speaking of S1s, in their S1, they certainly talked about how they started their business in short-term tourist rentals, and that's the lion's share of the business. But they also talked about experiences, longer-term stays, business travel, all these growth vectors that could help the company maintain, high growth rates for, a decade plus. Second, on operating leverage, are you experiencing operating leverage today? And can you demonstrate why that trajectory will continue? Companies want credit for their long-term margin potential. When they're going public, they're often quite a bit below their long-term margin potential. So as CFO, prove you're headed in the right direction, show the year-over-year change. And then lastly, can you accurately forecast your business? If you beat guidance 4 quarters in a row out of the gates, your stock price is up 25% on average. If you cannot, you're going to be punished in the public markets. So if you miss guidance in just 1 quarter, it's the flip side of that stat. You're down 25% from listing. And that's bad for morale, recruiting, M&A, general market chatter. So growth, operating leverage, and forecast capabilities are like the three things I'm always banging my head around for public company readiness.
Alex, that's a crazy stat. I just want to flag that for listeners. So correct me if I get it wrong, but if you beat your guidance the first 4 quarters out of the gate, your stock price on average is up 25%?
Yes, and if you miss guidance in just 1 quarter, you're on average down 25% from the listing.
You got to get that right.
You got to get that right. And so I think like the best advice is to start behaving like a public company before you go public, right? And set a goal and make sure you're beating raising as you're going into becoming a public company.
People from the outside think that a beat and raise model is pretty simplistic. Like, oh, you just, sandbag here a little and take it down there. But it's really like 4-dimensional chess when you start to do it out on paper and like what the outcome of 1 quarter versus the next is. Like it all has a knock-on effect.
Yeah, and like you don't want to sandbag too much because if you sandbag too much, you're also going to be taking unnecessary dilution probably at the IPO because you're guiding investors towards a lower number and they're attributing a valuation based on that. And so you're raising capital based on that number. And if you're going out at a lower value, like, yeah, it's easier to go up from there, but you're also taking on incremental dilution for your existing shareholders.
Dude, that was next level. I've never had anybody link beat and raise forecasted dilution, but you nailed it there. That was amazing. Last one I got for you. How have those expectations shifted in the past few years? What were these like qualities that you always have to have, or has the bar shifted?
Maybe the new one would be if you're preparing to be a public tech company and you don't mention AI in your S1, you're probably the walking dead. But in all seriousness, like I think those three qualities have held consistent over the last few years. I think what's changed is during the ZERP era, the CFO's job was much more skewed towards supporting growth, like quality one, supporting growth at all costs. Whereas today, like investors still care about growth, but it is much more balanced with profitability. So if you're preparing to go public, it's not enough to just show you're growing, but you need to show you're doing it responsibly. And so in that way is the role has shifted from how fast can we go to how far and how efficiently can we compound.
I love that. That's a great place to end. Alex, if people want to find you or want to read what you're up to, where can they find you?
You can find me on X. You can find me on a16z.com. And my team would even say LinkedIn. This was an awesome conversation, CJ. Really fun to chat with you about the CFO landscape and how it's changing of late with AI.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.